Let me ask you something. When was the last time you ignored a number because it didn't sound scary enough? Maybe it was a weather forecast, maybe a health statistic, or maybe a recession prediction. Here's what I mean. Right now, as you're watching this, Goldman Sachs is quietly putting out a figure. 30% chance of a US recession in 2026. And I know what you're thinking. 30%? That's not even half. Why should I care? And that's exactly the trap. Because here's what most people don't realize. By the time a recession feels real, by the time everyone's talking about it, by the time it's on the front page of every news site, it's already too late to prepare. The damage is already done. So let me show you something that might make you uncomfortable. Every major economic collapse in history, every single one, started exactly like this. Not with alarm bells, not with panic, but with quiet numbers that seemed easy to ignore at the time. Think about 2008 for a second. Before the crash, people were buying houses they couldn't afford. Banks were lending money like it was going out of style. And when the first cracks appeared, what did most people say? It's just a housing thing. It won't affect me. Then suddenly, it affected everyone. Jobs gone, savings wiped out, lives completely changed. And the wildest part? All the warning signs were there. People just didn't connect the dots until it was too late. So when I see a 30% recession probability for 2026, I'm not thinking about the number. I'm thinking about what that number represents. Because these predictions don't come from nowhere. They come from people who spend their entire lives watching money move through the system. And when they start getting nervous, there's usually a reason. But here's the thing that really keeps me up at night. Right now, at this exact moment, everything looks fine. Look around. People are working. Businesses are open. Your favorite stores are still there. The stock market is moving. Life feels normal. And that's what makes this so dangerous. Because recessions don't announce themselves. They don't show up with a countdown timer. They creep in slowly, like water seeping through the cracks of a dam. At first, you don't notice anything. Maybe you see a company announce a hiring freeze. Maybe your friend mentions their hours got cut. Maybe prices at the grocery store are a bit higher than usual. Individually, these things don't seem connected. They're just random inconveniences. But when you step back and look at the pattern, you start to see something else forming. Something that looks a lot like the early stages of an economic slowdown. And this is where it gets interesting. A recession isn't just about numbers on a screen. It's not just GDP dropping or unemployment rising. Those are just the measurements. The real recession is what happens to people. It shows up when businesses stop taking risks. When your company suddenly becomes obsessed with cutting costs. When that promotion you were expecting gets quietly put on hold. When the job market that felt wide open 6 months ago suddenly feels like a competition. And it happens gradually enough that you can convince yourself everything's fine, until one day, you wake up and realize the entire landscape has changed. So why are analysts pointing to 2026 specifically? Is there something magical about that year? Not exactly. But here's what is happening. Right now, multiple pressure points are building at the same time, and they're all scheduled to collide around that time frame. Think of it like this. Imagine you're holding a glass of water. Now imagine someone keeps adding drops to it, one at a time. Each drop doesn't seem like much. The glass can handle it. But there's a point where one more drop, just one, causes everything to spill over. That's where we are right now. The glass is getting full. Let me break down what I mean. First, interest rates. For years, money was basically free. You could borrow at near zero rates. Companies expanded. People bought houses. The economy was running on cheap credit. Then inflation hit, and central banks did what they always do. They raised interest rates, fast, aggressively. And on paper, this makes sense. You raise rates, borrowing becomes expensive, spending slows down, inflation cools off. Problem solved, right? Except there's a side effect nobody talks about enough. When borrowing becomes expensive, businesses stop growing. Why would you take out a loan to expand when the interest is eating your profits? So hiring freezes, projects get canceled, growth stalls. And it doesn't just affect businesses, it hits regular people too. Your mortgage payment goes up, your car loan costs more. That credit card debt you've been carrying suddenly has a much higher monthly payment. So what do? You cut back. You stop buying things you don't absolutely need. You delay that vacation. You skip the upgrade. And when millions of people do this at the same time, businesses feel it immediately. Sales drop, revenue tightens, and companies that were barely profitable suddenly aren't profitable at all. But here's where it gets even more complicated. Add debt into the equation. Right now, debt levels are not just high, they're historically elevated. Governments around the world are carrying massive deficits. Corporations have been borrowing for years to fund buybacks and expansions. And consumers, well, consumer debt is at levels we've never seen before. As long as interest rates stay low, this system works. Everyone can service their debt. Payments are manageable. But the moment rates go up, the cost of maintaining that debt skyrockets. Companies that were doing fine suddenly have to use all their cash just to pay interest. That leaves nothing for growth, nothing for emergencies, nothing for cushion. And in the weaker parts of the economy, this pressure starts causing failures. Not everywhere at once, but enough to create cracks. A retail chain closes some locations. A tech startup runs out of runway. A regional bank starts showing stress. Again, individually, these feel like isolated incidents. But when you see them happening across multiple sectors at the same time, that's when you know something bigger is happening beneath the surface. Now, here's the part that really fascinates me. There's the third element that's harder to measure, but just as powerful. Confidence. The entire modern economy runs on confidence. Confidence that your job is secure. Confidence that your investments will grow. Confidence that tomorrow will be better than today. And the scary thing about confidence is how quickly it can evaporate. One day, everything feels stable. People are spending. Businesses are hiring. The future looks bright. Then something shifts. Maybe it's a major company announcing massive layoffs. Maybe it's a bank failure that gets a bit too much attention. Maybe it's just a feeling in the air that things aren't quite as solid as they seemed. And suddenly, behavior changes. People start saving instead of spending. Businesses delay expansion plans. Investors pull back. And here's the kicker. Once confidence starts dropping, it creates a self-fulfilling cycle. People spend less because they're worried, which causes businesses to struggle, which causes more layoffs, which makes people even more worried. It feeds on itself, and trying to stop that cycle once it starts is incredibly difficult. So let me paint you a picture of what could actually trigger this thing. It probably won't be one dramatic event. It's usually a combination of smaller stresses all reaching their breaking point at the same time. Maybe it starts with a wave of corporate defaults. Companies that borrowed too much when rates were low suddenly can't make their debt payments. They start filing for bankruptcy. That creates losses for banks and investors. Then maybe stress appears in the banking sector. Remember what happened with Silicon Valley Bank? That was just one bank, and it created days of panic. Now imagine if that stress spreads to multiple institutions. People get nervous about their deposits. They start pulling money out. Banks have to sell assets at a loss to cover withdrawals. The pressure builds. Meanwhile, consumer spending drops because people are worried about their jobs and their savings. Businesses see revenue falling. They cut costs. More layoffs. Less spending. The cycle accelerates. None of these things alone would be catastrophic. The system can usually absorb individual shocks. But when they all happen together in an economy that's already fragile, already stretched thin, already running on fumes, that's when you get a chain reaction. And once that reaction begins, it becomes very difficult to stop. Now I know what some of you are thinking. But wait, don't we have tools to prevent this? Can't the government step in? Can't central banks do something? And that's a fair question. The counter-argument, the optimistic view, is that modern economies are more resilient than they used to be. We have better data, better forecasting. Central banks can cut rates if things get bad. Governments can inject stimulus. We've learned from past mistakes. And to be fair, they're not wrong. We do have more tools than we did in the Great Depression or even in 2008. But here's what history shows us, and this is important. Having tools doesn't mean you'll use them at the right time or in the right way. And it definitely doesn't mean those tools will work the way you expect. Because the thing about economic cycles is they're driven by human psychology as much as by numbers. And you can't stimulus your way out of a confidence crisis. You can't print your way out of a debt spiral. At some point, the fundamentals matter. And right now, the fundamentals are shaky. So why should you care about any of this? Maybe you're thinking, this is just financial stuff that doesn't affect regular people. But that couldn't be further from the truth. Recessions don't stay in Wall Street. They show up in your life. They show up when you're looking for a job, and suddenly there are 10 times as many applicants for every position. They show up when your company announces cost-cutting measures and your department is on the list. They show up when you want to sell your house, but nobody's buying. They show up when your retirement account drops 30% and you realize you might have to work 5 more years than you planned. This isn't abstract, this is real. And the people who understand what's happening early, the people who see the pattern forming before it's obvious, they're the ones who can actually prepare. Not with panic, not with fear, but with awareness and action. So let me bring this full circle. When you see a headline that says 30% chance of recession, it's easy to scroll past. It doesn't trigger the alarm bells in your brain. It's just a number. Just another prediction that might or might not happen. But if you've been paying attention to what I've been saying, you'll realize that number isn't the point. The point is what's already happening beneath the surface. The pressure that's already building, the cracks that are already forming, the signals that are already there if you know where to look. Because here's the uncomfortable truth about economic crashes. They never happen when everyone expects them. They happen when enough stress accumulates in places that most people aren't watching, until suddenly, all at once, everything shifts. And by the time it's obvious to everyone, the opportunity to prepare has already passed. So the real question isn't whether a recession is coming in 2026. The real question is whether you're paying attention to what's happening right now. Because if the pressure continues building the way it has been, if the debt keeps piling up, if confidence keeps weakening, if these multiple stress points keep converging, then the question won't be if something breaks, it will be when and how bad it gets. That's what keeps me watching. That's what keeps me paying attention. Not because I want to see the economy fail, but because understanding these patterns, seeing these signals early, that's the difference between being blindsided and being prepared. So what do you think? Are we heading towards something serious, or is this just another false alarm? Drop your thoughts below. And if you found this breakdown valuable, hit that subscribe button because we're going to keep watching these signals together.